Good day, everybody. This is Jim Kinney for the weekly update for the OptionProfessor.com. And this is for November the 30th, last day of the month. And this is 2018. Quick background on myself. I'm a graduate of Boston College. I've been in the investment arena here for many decades. And I have quite a bit of experience in all of these areas that I'll be talking about. So I feel that qualifies me to render my opinion, which is what I'm going to do here today. As always, I warn or tell everybody past performance is not necessarily indicative of future results, and short-term trading and option trading does involve substantial risk of loss, not right for everybody. So, of course, consult with your financial consultant, your clearing firm you're doing business with, as well as your good common sense before you consider any type of activity. Okay. All right. Let's get into it because we've had a big rally this week, and now we're coming off a little bit as well. Something I've been talking to you about is this 2,600 on the S&P area, which obviously has held up. And also, I warned you earlier this week that we could have a substantial rally if a couple of things were to occur. One would be some kind of dovish comments out of these Fed people this week. And the second would be if the meeting at the G20 showed some decent progress, or at least a suspension of the tariffs that are supposed to happen in January. Well, door number one has occurred, and you saw one of the bigger rallies of that I've seen in a long time, up 600 points on the Dow this week after our meeting on Tuesday, where we discussed that the potential of that happening could occur, and that exactly what did occur. Again, a lot of that, as I warned people, could be short covering. And one thing about short covering is there's no follow through on the buy volume. It can fall under its own weight. And that's kind of what's been happening in the last couple of days. The moving averages on a lot of these markets still hover above the market. So you do have resistance basis the 50 and the 200-day averages on most of these indexes right above the market. So you do have a cloud cover there. And basically, it's having a hard time going through it. Now, if we see after Saturday some real potential cooling or progress with China-U.S., we could be able to break through that resistance. But if not, that resistance could hold, and we could remain in somewhat of a trading range of 2,800, 2,600 on the S&P. So that's the overview that I see right now. And again, I'm going to get into this stuff pretty much detailed so you guys can get some input on what I'm seeing. Right now, you can see, according to my screen here, we're down about 65 on the Dow, up about 5 on the NASDAQ. They were higher earlier, as you can see from the graph on the day. Big things also going on the transports. They've rebounded as well as the Russell. But again, their moving averages are right above the market, and they could form a wall difficult to get through unless we get something good coming out of this China thing. Okay, let's take a look at the S&P so I can give you the parameters, as I always try to do, on what I'm seeing here in the S&P. And what I am seeing here in the S&P is 2737, basically flat, was as low as 2732, try to jump up to 2747. And you can see there, we hit the low of 2600. Then we went up to 2,800 on another short covering rally, came back down here to 2630 area, and then we had another short covering rally up to 2750, and now we're coming back down. Okay, now let me show you those moving averages that I'm talking to you about, so you get an idea of why this thing could be bouncing off of that area. The 200-day moving average is 2761. You see that right there where my cursor is right there. And then your 50-day average is 2778. That's declining now. So the 50-day is definitely turning over, and the 200-day is flattening out. The longer we stay under these two numbers, the worse it is for the market, unless we're going to get something out of the blue just take us north, which is possible. But again, being under those two numbers continually is not a positive for the market. You'd like to see it trading above 2780 and 2761 so you can get an idea that the market's back on the bicycle and not just having a short covering rally back into resistance, or basically taking an oversold position on the S&P and just mediating it out, bringing it back to more of a normal, shall we say, median price. Okay, not normal, but median price. Okay, so that's what you're looking at. I have a long-term monthly moving average that comes in right around 2,600. We violated it a little bit when we went down to 2603, but now it's back above it. That moving average has been rising for quite a long time. In my view, I watch the moving averages. And when the direction of the moving average is up on the long-term average, then you can still remain bullish overall. If that moving average were to roll over, and it would take quite a bit of time to do so, you'd have to get under 2,600. You'd have to stay under 2,600 for an extended period for me to turn bearish on the stock market. Otherwise, this market is really just having big corrections off of an overbought condition, which we saw in late summer. And basically, it has been correcting that overbought condition. And that's what's happening in the big picture right now. Okay, let's take a look here. And let's look at under the hood here. How are we doing on the transportation average? Again, why do I like transports? Because goods and services that are moved by, and people that are moved by air and ground, and the movement of the transportation average, I think, is very, very important. Today it's up 90. That's not bad. And you can see it broke above that area of about 10.7. So that's not bad either. So again, that's looking pretty good. And again, just because that is the line in the sand as far as the resistance right now. So let's go take a look at the 50 and the 200-day average here and give you an idea of where they're at. So here you go. Your 50-day average is at 10,671. We're above that, and we're above the 200-day. So on the transports, we're back above the averages. What's the only negative here? They're inverted, right? You got the 50-day under the 200-day. So if this thing can hang tight here and stay and maintain above this 10,750 area, then I think that's very constructive. If this cannot, and next week we start trading well underneath 10.6, 10.7, then I think this would be called a bear market bounce rather than a turnaround. But it has the makings of a 1, 2, 3 formation, right? You had a down move under 10, you had the up move to about 10.6, another pullback that did not take out 10, and now you're above the 10.6, 10.5 area, and that's constructive. And again, that could be telling us that the market's ready to make a turn. So keep an eye on that. Again, this is constructive pricing that I'm seeing here. Again, the negative is that the numbers are inverted, 50 under the 200-day. So it's got to maintain this price for a period of time to make it legitimate, in my view. All right, let's take a look at the Russell, because don't forget, in my view, the Russell and the transports were the leaders on the way up. They were the leaders on the way down. So let's take a look at the Russell and see if something's going on there. Okay, the Russell's up today a little bit, 1526. Again, the Russell really has not confirmed it as well, because it has not taken out that little peak there at about 15.9. And you'll find out that that area up there that it hit is also coinciding where a lot of the moving averages are. Let's take a look at the moving averages. Again, I like the moving averages. Why? Because they're based on price and time, and they give you a following of the price. Nobody knows exactly what tomorrow brings, but there is a theory of a body in motion tends to stay in motion. It's not 100% correct, but it makes a lot more sense than fighting the tape. And obviously, the moving averages are a way of trying to follow the tape. Okay, so anyway, here you go. You're at 50-day at 1569. So you can see why that 1570, 1580 area is important, because that's around the 50-day average. And then your 200-day comes in at 1614. So you're going to have some resistance possibly in that neighborhood. And again, we're still pretty far away from it as far as the price. So the transports are turning constructive, but if they faded next week, then you'd be back in the soup. And then as far as the Russell's concerned, little more price evidence before you can put your party hat on as far as that the turn's in place. Closing above 1614 would definitely get me very constructive on the stock market for the end of the year. Keep that in mind. Keep that on your radar. All right, now another thing under the hood would be the Qs. Okay, and there's your, but let's just look at the NASDAQ index. Forget about the Qs. NASDAQ is up 10 points today. Again, had the rebound rally way up to 7,600. And then basically, you can see it was way oversold. And then Powell's comments this week, which I talked to you guys about on Tuesday, and I talked to you guys about last week. You know, if his comments came out a little bit, obviously that's going to be very helpful. I'll put his comments into perspective when I go over the bond market in a couple seconds, though, because I think a little bit too much has been made about this. We're just under neutral, and I'll explain why. Okay, so anyway, the NASDAQ, here you go. A new low on that drop, that's not a good thing, and we haven't been able to take out 7,600. So the price evidence on the NASDAQ certainly is not that constructive just yet. Again, growth is under pressure, high PE ratios under pressure, and they remain so. Now you've got the golden cross going here as well. 75, 74, 76 is your 50-day. You see the cursor right there? Boom. And now your 200 days at 75.18. They've crossed. That's not good. Nobody can tell me that's good. But that doesn't mean it has to stay bad. And again, we're still well under the 2 moving averages. So as far as the NASDAQ's concerned, yes, it came into the 7,000, 6,800 support area. Yes, it is held. It is held. But again, right now, it's still trading under the 50 and the 200-day, and that's not constructive. Okay, so after next week's going to be very important. This thing starts falling apart, you're back into either a trading range or the downtrend. If it can get above those numbers I'm talking about here, then you've got a case to be made that we're back on the bicycle and the year-on rally may be on. Okay, let's turn to the VIX. Giving you some of the different ways to analyze this thing, right? Okay, the VIX. Now, again, as I've told you before, my view on the VIX, if you're above 20, you're in a very red zone. Red zone meaning the thing could parabolically accelerate to the downside as far as stock prices, if you're above 20. If you're between 15 and 20, the likelihood is you're in a trading range. And if you're under 15, the likelihood is you're in a bull move. Where are we now? We're at about 18, 19. Despite the 600-point rally the other day, they still couldn't get the VIX under 15. I think that's not a good sign. It could be a sign that after this China meeting, if it goes well, and we start rolling through those resistance points I mentioned, then, of course, this VIX underneath or down towards 15 would be good. But if you've noticed, ever since the VIX got above 15, we've had basically a market that's been deteriorating. Can you see when we broke above 15 in October there? So you don't really like it above 15, but 15 to 20, you could call it that we could be in a trading range as far as stocks. Above 20, you run the risk of jumping to 25 or 30 or even something worse if things got out of hand. I don't see that happening because I think this 2600 area may very well hold. But if it doesn't, I wouldn't be worrying about that 2530 on the S&P that people are talking about, because if it gets under that 2600, it's probably going to be for a reason. And you could get, that's when you could get your washout. And in my view, the washout could be as bad as 2420 to 2460. So that would be a real washout. But again, there's no evidence of that right now. That's off the chart right now. Right now, the VIX is in an area where it's kind of a stabilized area, 18.9. Okay. But let the numbers tell you what to do. It's always best to follow the numbers and not do too much predicting. You know the old saying: those who live by crystal balls are destined to eat ground glass. And that's an old saying, and I think there's some merit to it. So try to follow the numbers with the moving averages and the price, and not so much on what gurus or the guy down the street's telling you. All right, let's do some roundup here on some other markets. We just went over the stock indexes and some of the main things that are going on. Let's look at some of the sectors. You know, a lot of people think that if we are turning around, that the value stocks, such as industrials, may turn the corner. Okay, let's take a look. Okay, this is Vanguard Industrials. Obviously, there's an ETF all over the place. I'm just picking some Vanguards because I have the symbols here. You obviously can look at any ETF you'd like. Okay, can you see? We had the low, very oversold, bounce back up, come back down. You're trying to set up a 1, 2, 3 formation. The third has got to take out that 137. If you get above the 137, that would be very constructive. Okay, so there you go. There's a setup for a 1, 2, 3 formation, but if it starts taking out 130, all bets are off. So right now you're kind of in no man's land with a bias to the upside, meaning we've had a pullback that did not take back the former pullback. So right now the bias is to the upside. Confirm the upside a little bit by going above 137. Tell you this is just a head fake in an ongoing downtrend, take out 130. Okay, let's take a look at your materials. Materials. Okay. Again, another one. Now, again, a lot of people are looking for prices to be increased next year. You know, the tariffs and the buying power of the consumer. I'm seeing it in my own life. People are raising prices. Okay. That's, in my view, is happening for sure. But again, here you go with the materials. If there was to be a big move on hiking material cost, again, you are setting up a 1-2-3 formation. You have the low down there, rally to 125, you pull back to 117, 116, and now if you can take out 125, that would not be a bad situation. There should be quite a bit of resistance at 130, though. Look at all those lows. When a support level breaks, it becomes resistant on the way back up. But at least there could be a possibility of a constructive uptrend, I think, if we can get above 125. Okay, there's your materials. Some people are discussing a portfolio including healthcare, financials, utilities, and oil. And some people are believing that that's a fairly defensive portfolio going into next year. So let's look at those four sectors and see how they look. Again, I'll be referring, there's plenty of these ETFs out there. I'm just showing you the Vanguard one on healthcare. Okay, let's see if that makes any sense, either trend-wise or anything else. Okay, well, you can see if you've been hiding out in healthcare, you've been staying pretty dry, right? Because it went down, but it's right back on the bicycle, right in your face again. Went down all the way to 162, but boom, right back to 175. That's a good sign. Now let's take a look at the moving averages. Now, again, the demographics on healthcare are fantastic. And although there's a lot of jawboning about bringing healthcare costs down and blah, 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 it's not really happening. And it could be a big thing for the Democrats to get some kind of healthcare program going. I've always believed that if you wanted to get everyone in on the healthcare thing, because one of the problems with Obamacare is that the younger people wouldn't buy any insurance, right? So your numbers didn't work out. They didn't crunch out. But if you put some kind of a situation where you had to buy healthcare if you have a driver's license and you can't renew your license unless, or you can't renew your registration on your car unless you have insurance, I think you get everybody to buy it, like you get everybody to buy car insurance, right? Who'd buy car insurance if it wasn't necessary to get your registration done? So I'm not a genius, but it sounds to me like that would be a pretty easy resolution. Turning back to trying to make some money here, look at this, 175, where's your 50-day? 169, where's your 200-day? 164. This thing's not bad. And looks like it's got good, strong support at 160. So this sector does look pretty solid. That doesn't look like a bad deal to look into. All right. Door number 2 on the sectors were the financials. Now this thing's been touted so much, it's starting to be annoying. You know how? Let's go to XLF, and XLF is your financial index. Now, as you can see, people touted this thing hugely because, according to everybody, when rates rose, it was supposed to help the banks. Well, if loan demand isn't that strong and your expense on deposits is equal to what you charge on the loans very much, then your profits don't grow as much as you think. That, I think, has been the prevailing story. Now, you had a very big sell-off here on very high volume. Can you see this right here? And that's a good sign for capitulation. You see this right here, the volume down here, very high around this area, right? And it actually was lower volume during the next leg down. That might not be a bad sign. Now, you're at 25 as a support zone right now, and you've tried to do your 1-2-3 formation. 1 up to 27.5, back to 26. We don't take out 25. If we take out 27.50, this thing could be on the bicycle. Now, let's take a look at the moving averages and see if they confirm. Okay, moving averages on this, 26.34 and 27.52. Not a good relationship on the moving averages. Where are we trading at, though? We're trading at 26.80. So we're above the 50-day, so it's starting to make a turn. And we need to get above 27.50 to make a legitimate turn. And then we need to hold above 27.50 so that these averages can turn back up. But it does look like 25 is a darn good support area. 26.80 is certainly not a whole lot of distance between. And by having a diversified portfolio, you don't get stuck with a Deutsche Bank, or you don't get stuck with a Goldman Sachs, who obviously are getting possibly caught with their fingers in the jelly jar. And obviously, they're going to get their hands slapped possibly. And that's why those two stocks are under some pressure. So that's why you go possibly with the diversified situation, because you get specific stock risk and those type of things, and you're going to have a lot bigger drawdown than this has had. So again, this does look fairly constructive and doesn't look like a terrible place to hide out. It certainly has been hanging in there better than some individual stocks, that's for sure. Let's turn to the next one. First one was healthcare. Second one was financials. Next one was utilities. Now, again, this is a Vanguard utility. Let's take a look at what it's doing. Looks like it's been hanging in there pretty good, right? You know, so again, the third leg on the stool is utilities. It pays a good dividend, 3% here, but I'm sure there's other ones that even pay more. And then you're looking at what type of a trend here. Again, these are things, people are going to have to go to the doctor and pay on healthcare. People are going to go to the bank. People are going to turn on their lights. These are why the four that we're talking about are kind of defensive, but also they look like they're doing okay. Again, here's your moving averages: 117, 115. 117 is your 50-day, 115 is your 200-day. Where are you trading? 122. Not a bad place to be, right? As far as the trend and as far as how it's been doing lately. Okay, so there you go, utilities. Now, the last leg on the stool, the fourth leg on the stool, again, healthcare, financials, utilities, and the last one is oil. Let's take a look at the oil situation. Again, we had a big jump in the price. What are we going down to? $20 oil? Probably not. And you think Russia and Saudi Arabia over that meeting at the G20 might be talking about cuts and trying to stabilize this price? Russia did say they like the number 60. We're not at 60, we're at 50. So that could be helpful to the oil situation. All right. So what do you got going here? You've had a big drop from around 80 down to around 64, right? We're trading 66 about. Okay. Pays a decent yield. You getting 3% on your money to watch the movie, right? That's the current dividend. And what are we looking at as far as volume? Looks like the volume's been very high during this last sell-off, which means all these people that were long have given up. And that's a good sign, because once the selling dries up, that's how you go the other way. Don't forget, every stock and every commodity and everything you buy is a supply and demand merchandising operation. There's either a seller and a buyer even up. There's a tremendous amount more sellers than buyers. Then you got to tank the price, right? Tremendous amount more buyers than sellers. Then you got to make it go through the roof. But those order imbalances can, go away, and they don't last forever generally, right? So there you go. The order imbalance has been to the downside. Has it all dried up? It may have. You got a line in the sand at the 52-week low, 63.44. So you got something to trade against if you're trading. If you're looking just to park, you're going to get a decent dividend, and you're going to be looking for the energy prices and the energy companies to rebound. And again, that's part of a four-stool program: healthcare, financials, utilities, and oil. Not a terrible place. Two of them are paying pretty good dividends, above 3% generally, and that's your oil and your utilities. And then you've got the banks and the healthcare, which obviously are companies that you're looking for their profits to increase. Okay, so that gives you a little bit of a rundown if you're out there trying to figure out what's up as far as stocks is concerned. Now, let me do this. Notice I didn't talk about tech, because I think tech is obviously having its problems with their data controls and other situations as far as valuations, and that's why you're getting a little bit of a dodgy situation there. One last stock I'll show you, because everyone owns this or is interested in this, is Apple. Let's take a quick look. That had a pretty good dump, still under some pressure. Again, when a company announces that what they get, I believe, 60% of the revenue from, which is the iPhone, and they're not going to tell you how many they're going to be selling quarter to quarter, that is a curveball. And when companies throw a curveball, some people get out of the box. And that's basically, I think, what's gone on here. When we go from 230 down to 170, people are very concerned that the meat and potatoes of their business, they're not going to be reporting on. And they're hoping that services and other things they're getting involved in will make up the difference. That's a come line bet. And that's a situation where people are what? Not, they want to see the whites of their eyes before they put their money down a little bit. Okay. So on the defensive there, looking at your moving averages, though, I thought this 170 might be a reasonable place to take a shot. So far, it has been. And you have got moving averages at 204 and 193. So you're substantially underneath it now. And that's why a rally up towards 190 or 200 could happen, because you're so far underneath the moving averages. And 170, the recent lows, would be your line in the sand if you thought there might be a rally. But again, the bloom definitely came off the rose here. But it could, again, look at the moving averages, have a rebound rally. So respect that. You saw this week, if you sell into low areas in a market that's rolled over, they can bear market rally you very quickly on short covering, etc. You saw that with the S&P this week. You could see it in Apple if they start announcing that Christmas is going good. All right. Let's take a look at some other stuff going on, which I think is important. The bond market. Okay. I told you last week that the treasuries had a little bit of a rally up towards 3.25, and it was getting a little overbought. Let me show you what I mean by that. Let's look at the moving averages on the yield on the 10-year. That'll tell you something. Yeah, 2.95 is your 200-day average. You went up to 3.25. That's a pretty good distance away from the 200-day average. And so now you've come back down toward it. That's why it's holding this 3 area so far. I think 280 is a big part as well. So 280 to 3%, I think has a good chance of holding, if not 3, because you can see the former highs there around 3, and you can see we're touching 3 now. Now, let's get to what Powell said, and let's go, figure out what he really said. There's a range that they're looking for on their dot plot of 2.5 to 3.5 on Fed funds, and they are currently at around 2. So when he says we are slightly under neutral, he believes that that range of 2.5 to 3.5 is neutral. So if you're at 2, what would you say if 2.5 to 3.5 is your range for neutral? You'd say that we're slightly underneath what could be neutral, right? Okay. He didn't say he's never going to hike again. He didn't say that no matter what the data is, he's changing his course. He didn't say anything like that. But a market that is desperate for water, if it sees anything that looks like water, is going to jump on it. And when the order imbalances to the downside, you're going to get a big, big rally on short covering and some spec buying, which is what you've seen. Now, what do I think might happen here? Well, I think it could hold the 283 3% area. And I think that he said something in the report that they don't talk about. He's watching jobs and inflation. Why is he looking at that? He's looking at jobs because people are getting paid more, and so wage inflation is probably going to hit the fan. Number two, he's looking at what? Price inflation. I already told you my personal experience, and I don't know what you guys, but everything that used to go for $1 seems to be going for $1.40. Everything that used to be going for $6 is now $6.95. It's little stuff, but it's stuff that people use every day. Right. And so there is some price inflation in the system. And I think with the tariffs, companies are with the consumer at 3.8%. And he's obviously spending money still because look at those sales for Christmas online, et cetera. They are going to and have already started to raise prices, which I think will show up in the data. You can't have 2% Fed funds if inflation starts picking up. And Powell knows that. And that's why he's not saying anything about cutting rates. He's saying what we already know. We're at 2% or so on Fed funds. And the range for neutral, he believes, is 2.5 to 3.5. So obviously, what does he say? We're slightly underneath what could be neutral. He's also saying watch your jobs and your inflation because he can see it picking up. That's my call. Now, if we start breaking under 280, I'll change my mind. If these numbers fall apart, but he's not in the job of getting real estate to triple in price every day. So real estate has had a big run and now it's coming back down. That's all that's going on in real estate. Okay. It's quieting off. He's not going to change fiscal policy. And let's talk about debt. The government has a tremendous amount of debt coming on the market. 1.3 trillion in new money has already been done. So there's a lot of supply coming on the market that has to be eaten up. Okay. Now, one last thing, and then I'm going to sign off for this week. And again, I'll tell you exactly how you could contact me if you have any questions on anything I'm talking about. Gold. Okay. If we're going to have a pickup in prices, if we're going to have some inflation hit the system, is it possible that gold could go on the bicycle? I say yes. Is the jury still out? I say yes. Why? Because I need to get above this 21 area on GDX to tell me that we're on the bicycle. So far, there's still a overall downtrend to the gold. But if we get above 21, I would be looking at this thing very seriously if it was combined with higher inflation numbers. And again, one last thing before we go is the US dollar. US dollar looks like it's trying to roll over a bit because that dovish talk is not bullish for the dollar. And let's take a look at the dollar and see what might be happening here. We're right around 97, 98. Watch the dollar. If we take out 96, if we take out 95, 94, I believe that that gold will fly. So don't do anything as far as I'm concerned yet on this because the jury's still out. But if you start seeing reversals in the dollar and reversals in gold, I would probably take a bite of that if I was trying to diversify my portfolio. All right. Listen, we went over a lot today, and there is a lot to go over and a lot of option strategies that can be used in this area. Again, collars when it's very high, replacing stock with limited risk calls when you get nervous if you still think you're going to be bullish. Lots of ways to handle this, animal. Give me an email at OptionProfessor@gmail.com. If you have any specific questions you want to cover, I'll be able to give you a hand. Otherwise, until next Friday, I would like to wish you all a very good trading week, and we'll see how this G20 works out. It should be a very interesting week next week, and I'll be with you next Friday. Until then, have a great weekend, everybody, and thanks for tuning in. Don't forget to tell your friends and associates that they can tune into this podcast, and you know how to get the link, so just tell them how to get the link and let them enjoy it as well. Thanks for being here, guys. We'll see you next Friday.